Hey guys, Freaky Finance here. Happy New Year's. It's 2021 officially now. Today, I'm just going to do a short annual recap for the end of 2020 and what my thinking is going into 2021. So anyway, I started this YouTube channel about 5 months ago in an effort to help people make more informed decisions with their capital. Originally, I was worried that people were just simply jumping onto names they knew and throwing money at them because they see them every day. And anyway, I was like, well, maybe I should show people perhaps a different way when you really dig into the numbers and try to understand what you own. And so that's what drove me to the channel making. It's not obviously with 80 subscribers, not like I'm making money. I just do it because I like to do it and I think it might help some people with allocating their capital. I wasn't expecting any subs, given I'm not much of a salesman or advertiser or marketer. So yeah, thanks to the 80 subs so far in 5 months. I hope you do like the content. I like doing it. And yeah, obviously I have a little bit of affinity with financial statements because I'm kind of a geek and I just go through so many in a week. From a personal, self-serving level, this channel also helps me rewind the clock and look back at my own decision making and decision process and decide if I was right or wrong. But more importantly, if I was right for the right reasons at the right time. And ultimately, like I said, I do love looking at financials and companies and deciding whether to invest my own money or not. It's part of who I am. Like I wake up on Saturday all ready to go and dig into another company. Might do it when I'm off work. Yeah, I am honestly surprised to have 80 subs in 5 months. Slightly flattering, but I promise I won't let the ego go to my head. Anyway, this video is going to start with my forward macro thoughts going into 2021. And then I'll jump into a recap of some of the decisions made during 2020, as well as some of the current positions that my mind keeps wandering to in the middle of the night. So anyway, hope you enjoy this year in review. So, the macro thoughts, reflation is in focus. I believe countries will continue to ease into the rollout of the vaccine, likely to err on the reflation side as opposed to stagflation. So if growth slows down, but the inflation's still kind of escalating a bit, I think the government's still going to keep stepping on the gas over and over again. Deflation will just lead to more of a policy response. So what that means is still long, say Freeport, more, and so down here. This list is just some alphabetical companies we've made money or lost money on throughout 2020. This is the bulk of them, it's about 40 of them. So Freeport's down here, and you can see that on that video timestamp. Fairly good return. I still think Freeport is going to kill it. Copper prices where they are in their production ramp up on schedule. This is going to be a cash flow machine in the next actually 4 years. And the last year has the capex coming down, if you remember from that video. I know it's been a while. What else is there? Nutrients, so potash. So up here, I haven't done a video on this one yet. It's a potash play. It actually picked up a little bit from some riots in Eastern Europe. And then, so not at my control, I wasn't a part of the investment thesis, it was just a reflation play. But obviously when supply is challenged, then you get an extra tick up. So still long veil, so down here as well. Now it was just around 17, I guess it closed yesterday at 1677. So now they're around the same increase that Freeport has. Though Vale doesn't have that crazy ramp up in copper. I mean, it's an iron ore play. And that one just has the nickel tick in Canada as well. If you're going long electronic vehicle batteries, it's probably going to be a material supplier. So that's the reflation. It's just 3 that I picked out of my existing positions at the end of the year. The next thought I'm still looking at opportunities related to the weakened US dollar. A lot of assets have already increased because of the weakened US dollar. So that idea is kind of becoming more mainstream now instead of like it wasn't 4 months ago. I'm also increasing foreign equity and fixed income exposure, or trying to. I'm looking at opportunities in that. I still have some exposure to China that I'm looking at adding, but I'm not sure when. So I'm still going through some ETFs on that. That's just how I've been playing them. So HCN here is just a dividend yield focused. I think this one displays a 6% dividend yield. It's not the standard companies you're used to seeing or the tech China companies, just a bunch of other China companies. And then this ETF as well, XCH, I own that one as well. And again, these things haven't really moved at all since I've been in them, 1%. And I think XCH plays a small dividend, but that's not the reason for owning this one. This was just a play on Hong Kong because it's just Chinese companies listed on the Hong Kong exchange. But I'm looking at other ones, specifically China Tech. The thinking with the China Tech is basically you have all these American tech companies that are priced quite high, and you have Alibaba in China, which is priced quite high. But relative to the size of the American companies, the China companies are quite small. And so if you actually believe China will eventually catch up and perhaps replace America as the world superpower in my lifetime, then it makes sense that you might want to start investing in some China tech. I mean, obviously the hard thing is when, and then you have all this regulatory crackdown noise that you cannot control. So it makes quantifying a decision harder, and you have to almost be qualitative in it. So I need to do more digging on that. Specifically, if I'm trying to pick certain companies. Obviously, if I'm just picking an ETF, I don't have to know the individual companies as well. But I still like to, especially if there's high weighting. Like most Chinese ETFs will have like a 20% weighting in Alibaba, quite a lot in Tencent, quite a lot in Baidu. PDD's up there now, Pinduoduo. So yeah, quite a lot. YY, Bilibili. There's quite a lot of tech Chinese companies that are getting bigger, but they're still small relative to the States, and that could be a play almost like what we did with cannabis 3 years ago. We went from Canadian cannabis to American cannabis, right? Same kind of thinking. Third thing, personally, I lowered duration on the remaining fixed income securities. Actually sold quite a lot of fixed income during this year and rotated. That's where these positions came from. I wasn't just sitting on cash. I had to rotate from higher duration fixed income because you made money on the lower interest rate during the first part of the year, and then you just sold and bought into some opportunities as people panicked. Fourth thing, what else for fixed income? I also lower duration mainly due to the skewness in the developed world, as interest rates are eventually more likely to go up than down, just given the fact that they are already so far down. I mean, you could always go negative. Would not be good in the States if they did, but you always could, right? There's less chance of further downside in interest rates, which means less further upside in bonds for capital part, and so you don't want that sensitivity of duration if you believe interest rates will eventually go up, especially if inflation expectations start to tick up. So I just don't, and you're not getting paid for it because the interest rates are so low that the coupons on most things that are investment grade are crap. So the fourth thing, I am buying some gold. I'm still long. I haven't done a video on any gold actually since I started the channel. I'm still long Argonaut gold, still long Grand Columbia gold. Unfortunately, I'm still long Oceana gold. Actually my biggest loss of the year. So that's down $1,400. And that's a company that, well, really it's the mine specific risks of the Philippines. Then when you're labeled as a miner that doesn't get the populace, the local populace on your side, or the government's on your side, that's what happens. So even though gold had an amazing year, as we expected, this company underperformed because of its specific risks. Fifth thing, US dollar will likely keep devaluing in the short term. I've already touched on this. Though if it spends enough, like the government keeps spending enough, more than other countries, it may get the growth required, which could strengthen it ahead of the other countries, if that makes sense, down the road. So not obviously immediately. This happened in last recession as well. It was the first one out of the gate, so the currency remained okay. I mean, relative to other countries, it didn't. So it really depends where you are. Like last recession, the Canadian dollar actually strengthened quite well against the American dollar. So there are things that are specific to each country on a relative basis when you're talking about US dollar weakening. You have to think about US dollar weakening to what? For example, say China and South Korea, they appear much more adept at handling the virus, so they never had to print money in the first place. So relative to as much money, I should say, in the first place. And they had different avenues of stimulus, right? China controlled spending through coupons and vouchers. So slightly different, but I think coming out of the virus, the Chinese currency and the South Korea won should do quite well, and they already kind of are. I think that trend's going to continue as all these countries keep having to print more money to bridge the gap. I don't think that changes with Biden. I think it just accelerates it. What's else? Another macro thought, I'd say likely overweight healthcare. So lately I've been trying to find companies whose share price have lagged, but likely have a large buildup of healthcare procedure and treatment demand on the horizon. So basically the thinking behind that is people not going in timely for routine checkups for their ailments, which means their ailments are getting worse, which means more money for healthcare companies once people finally come in. So one of the companies I pushed the button on. I talked about that on the J&J call last week, or 2 weeks ago now. So GoodRx holdings up here. You can see I have a small position in that one. It hasn't moved too far from when I got in. That's just a play on more people going to their doctors after COVID and likely going to get a prescription. That's all that thinking is for that one. And also, it's cheaper than it was since it's IPO because the world's afraid of the Amazon Death Star. So, but anyway, that's one of them. I was looking at like J&J, obviously. A lot of companies have pent up demand. I think that's a term we're going to hear a lot in 2021. We've heard it a lot in 2020, but we're actually going to see where there is pent up demand and where there's not. And I think there's quite a lot of pent up demand in healthcare because people are really scared to go to the doctor, especially the people that need to, and especially the older demographic, which are more likely to have prescriptions and multiple prescriptions. There's going to be a lot of sick people needing healthcare treatment and healthcare in general. What else? Next year is going to be easy comps if there is normalization. So if the vaccine rollout on plan, Q2, well, it still might have not a good vaccine rollout. Q2 next year's the Q2s that we had in 2020 were horrible, really bad. And so even if things are like they are now, which seems just as bad, the comps aren't going to be horrible. Versus last year, they were truly horrible. So, and I still think easy comps in Q3 and Q4. Though at the same time, you have some headwinds, like just I have this weird kind of thought in my head, like if the economy normalizes, that should mean less stimulus, and you have these comps that are stimulated up. I'll have to work through that on a company by company basis. So going more specific, so industry specific opportunities. Kind of like just touched on healthcare. I'm looking for opportunities in energy, so ways to play the capex cutbacks so many energy companies made during the year of 2020, and it's also a way to play an eventual return to international and domestic travel. Demand isn't permanently lost here, even if, and I think the forward oil market is trying to capture that, right? So, and again, energy companies have some pretty easy comps. So Q2 is going to be really easy for these guys as long as oil doesn't go to negative again. But yeah, I'm looking at some energy companies because no one's in them anymore. They've all been, if you're an energy company and you're an institution, you probably got a talking to in the last 5 years, which is unfortunate, but that's the reality of money management. But for us, we can create opportunity. Second one, I'm looking for opportunities in travel and hotel. You can see I kind of have some interesting holdings. So I have Expedia down here, small one. The reason why I pushed the button on Expedia is that when Airbnb went public, well, I was like, well, Verbo is Expedia, and Expedia looks pretty cheap relative to Airbnb now that Airbnb is public. So I don't think people really understand what they're buying here, or at least either Airbnb is overpriced or Expedia is underpriced. I'll take the Expedia underpriced, and then if I'm wrong, you're still going to get this tick up in international travel eventually. I think a lot of people are sitting on the sidelines wanting to go, and you've heard people trying to go during the holidays and getting socially condemned for it. What else? Carnival Cruise, so I own a small position in that one. Just down here, you can see. And again, that's the same thinking. And then America Hotel REIT, and that one is a little bit more interesting. That's the one we did a video about. So that's up here. And you can see this one has that occupancy over a certain level and they're free cash flow positive. That's it. And as long as they stay over that, they're going to be fine. And eventually, through normalization, they'll be able to come back fully. That's the idea with that one. Just another hotel play that no one knows about. That one's still down quite a bit year to date, so I like that play. And if it comes back against me a little bit more, I'm probably going to add some more into it. So yeah, that's the travel aspect. And I think the vaccine rollout helps most of these travel companies because it gives the lender the confidence that this will end, and they can see what the company was able to do in the past. So it's like, okay, if you're right, if there's some kind of normalization, which people think will happen, right, then these companies really are just bridging it, almost like the government would be bridging it, right, for stimulus. So that's the same. I think it's easier for lenders to lend to these guys than it was in the past before the vaccine. Still looking for opportunities. So the third thing, still looking for opportunities in REITs. So, I mean, hey, American Hotel REIT is technically a REIT, but I'm looking at quite a few. I did that video on H&R REIT. I think it was one of the first ones I did. I'm going to do a couple more on other REITs. I did another office REIT and a grocery REIT. Anyway, I'm still looking at REITs. they're kind of in an interesting spot. REITs are still sold off quite a bit depending on what they're in. So obviously retail REITs are hit hard, office REITs have been hit hard. And so that's where I'm going. These are the companies that are still down 30%, even though some companies that are really impacted by COVID are almost actually performing better. And these companies are still generating cash flow to cover their dividend yield, but they're still down. So when I can get a discount on NAV, because the general consensus is, oh my god, retail is never coming back. People are never going back downtown. People are never going to work again. I think there's some truth to that, but there's not that much truth to that. So there's a usually the media will focus on one thing and everyone think that way, and I like to take the other view all the time on that. So I think some people work from home, and I think there's still going to be office space for them. I imagine with my job, I'm probably still going to be in maybe 3 or 4 days of the week, but we'll see. You never know. So I'm looking at that, and then on the retail side, I think eventually retail will come back, and I think the people, well, not all the people that have moved from the city, but I think quite a few will come back in over time. There's a reason that people were in the cities to begin with. That's what I'm thinking. It's not a popular view, but I like to think different. The fourth one, I'm still looking for opportunities in utilities and telcos. So did the one on Bell Canada. Looking at Rogers as well, they both look pretty good. Utilities, I own Alta Gas, so that's up there. That's an interesting one because at the same time I was looking at Atco Gas. Very well, kind of similar, kind of different. I'll do a video on one or the other pretty soon here. But anyway, that's just a utility play. And for Atco, for example, I'm still looking at it because Alta Gas has shot up since I bought it, whereas Atco's, I haven't bought it, but it's still just sitting around. I'm like, well, why is one going up and it's not? So I'm gonna probably do a look at Atco in a bit. That looks pretty interesting. Anyway, the fifth looking for opportunities, that's in cannabis. So I did a video on Columbia Care a while ago down here, so you can see Columbia Care, still own the CURA leaf, still own TRUL leaf over here, and still own Green Thumb. So quite a bit in US cannabis exposure, I guess, in aggregate, but I'm comfortable with that. I think these companies are still, they're growing quite well, and I mean now I think 2 of the 4 have scale that I like, and the other 2 are going to have scale that I like, or that's why I'm in them. But 2 that I've seen this trajectory. I just thought first with TRUL Leaf, and then Green Thumb was able to do it with Illinois, and so it's just, and Cura Leaf is starting to do it though. Like I mentioned, they have a higher SGA profile, and Columbia Care, I mean, it's starting to take off. Next thing, eventually I'm looking to sell the groceries. Albertsons is the only one that I really own on that angle. Lately it's started to move finally. And I still think Q1 is going to be amazing for this company, or the next earnings in January rather. But again, the last quarters have been amazing, and the stock has barely moved. It's started to recently come up. So, but I still think, I mean, this grocery chain, Albertsons, relative to all the other grocery chains, is still cheap. Though it could stay cheap, right? Cheap is not a catalyst, but it should be over time. Or at least that's why I'm in it still. And I still want to see what this next quarter is going to be and what they guide to and what they're doing with the extra cash they've been getting. 7th thing, I'm going to continue to find high yield dividend companies that look attractive in a low interest rate environment. So it's kind of almost like a bond proxy, similar to the REITs and utilities, honestly. So things that are still down, but I'm like, why are you down? And I look and see, okay, you're down 30%, but your income's down 10. And I'm like, well, that means you're cheaper. And then I might buy it, right? So that's why I'm looking at that. People aren't looking at that right now. They're still not very attractive. Other than not sexy companies like, oh, I'm gonna look at Atco Gas, but I will. Anyway, so for that I own the Keg and Boston Pizza royalty. So Kegs and K's right there, Boston Pizza right there, and then I guess, I mean, I kind of talked about energy. I have Enbridge actually down in that position. That's an interesting one. Probably I might even add to that in a bit. I'm gonna do a video on that. I think the dividend yield is very high. The cash flow stability is very high. They have an interesting tolling agreement with the government of Canada where it's linked to the Canadian GDP. Anyway, it looks very interesting. I started digging into some of the financials, I want to say 3 months ago. I never did a video on it. What else? Eventually, I need to sell some tech that's rallied. So the hard thing is it's hard to replace the tech when it's rallied, right? I still always want some type of tech exposure, right? So that's why I'm looking at China tech. I still own Zendesk down here. I still think my next quarter is going to be good. So I'm still holding on to that. And I'm still holding Cloudflare, even though that thing has gone quite high and it's starting to pull back. So I need to start getting my head in gear with that and what I'm going to do with that once things do normalize, right? Though both of these are interesting technological plays in their own way. In a way, it kind of offsets the REIT risk that I want to start taking. Kind of. I mean, Zendesk, you think, is Salesforce for poor people. That's how I do it. And then Cloudflare, maybe. I mean, obviously, I haven't done a video on that, but that's security. I think Cloudflare has pretty good business, though at the same time, I have to keep him head. It's just gone up so much in this last 9 months, really. So, anyway, I got to think of what to do with the tech positions. And then the last thing, I'm always trying to find longer term biotech plays that have less systematic risk, but obviously higher idiosyncratic risk that I think it's willing to get paid to take. And that plays to my research background. I like digging into companies and whether it's financials or phase 3 or phase 2 clinical trials. I like going through it and being like, okay, this looks significant or statistically significant, I guess, in the case of clinical trials. And you can see the only one that I really have right now on is Antibi Therapeutics. I also do own Molecular Partners, but that's not on this list. So overall, for 2020, I think we got more right than wrong. And while I didn't see the virus coming, we were luckily positioned defensively, which allowed us to sell VAB and XSB bonds, just bond ETFs, and rotate into the equities in March, April, and May panic. It's a lot easier to find opportunities if you have a plan and take advantage of material pullbacks, and that allows you to keep your head while others are losing theirs. That's Howard Marks quote. That being said, I did get nat gas timing wrong, so you're going to see 3 reds on here. You got AAV, Pay2, and Birch Cliff, all in the negative double digits. 11, 9, 13. Those are all nat gas plays. So all 3 of my nat gas plays are negative on the year. It's kind of sad. So didn't time nat gas right, but it happens. I'm still in them, so obviously I think there's something to be said with nat gas. And I'll probably do a video on nat gas in a bit. But on the whole, 2020 was a good year for analyzing companies and rewarding for putting in long hours of going through them. More importantly, we are able to still get good prices on select securities, and that's kind of been demonstrated in the June to current period. Personally, I'm unsatisfied with Intel, so up here you can see this thing is pretty much flat, though the thing has been yin-yang up and down 10% on me. And a part of me, like, this is the one that Intel I keep going back to, even though, say, it's only $4,000. I'm thinking, am I gonna get pain in January? And there's so much noise, and my brain, for whatever reason, keeps going back to Intel. But I don't know if that's the media coming at me all the time. No, you gotta reevaluate Intel. You might be wrong. And I'm like, well, I'm probably wrong in the short term. But at the same time, I mean, you're just a cash flow machine. So it's hard for me to step away. And if I do think there's gonna be short-term pain, I should just technically sell right now and add back at the end of January when they do their next earnings. So I have to think about that. I'm also thinking the stimulus focus and the government is here to help narrative of 2020 will create second-level issues that most public service people don't have the capacity to account for. And I think, obviously, there's opportunities out there that I'm not thinking of yet. So I gotta keep thinking, okay, what is the second derivative of what they're doing now? Well, what's the second derivative of $2,000 stimulus checks? Does that mean Q1 2022 is going to be horrible on a comp basis? I don't know. But I got to start planning that out, right? And does the stimulus behavior change people's behavior? Do they become more addicted to the stimulus to start increasing their spending even though they don't have the budget for it? And then are people parking the money for all the payments they have put off? You know, there's some views out there that people have put off their mortgage payments, right? They don't want to defer them. I'm just gonna invest it or save it. And so what happens when people have to pay rent and mortgages again? Assuming they didn't pay, it could mean currently company earnings may be higher as the individuals may be using the money that they would otherwise go to basic shelter to more discretional goods and services. It could also mean that money they didn't spend on basic shelter was parked into the stock market, which could help explain some of the mania we're seeing in some of the names that everyone knows. And furthermore, does that mean that when the expenses normalize, who will they take the money they parked out of the stock market? And moreover, media has portrayed the do-it-yourself investor as smart, and financial technology makes setting up your personal trading account very easy to link to your bank account and deposit funds, and you get your free two stock share, free two stocks. And I also believe that do-it-yourself narrative is playing into the narrative I just mentioned, with people just buying into what they see every day. Positive, though, with that is that the money is flowing to innovators and dreamers. So, I mean, if you're able to get money from retail investors, your share price will go up, right? And however, if you actually have that innovation dream and drive, it could accelerate change, right? I mean, I know it sounds kind of silly, but you could use your share price as a currency, right? And you buy real companies. So say if you actually didn't have a real business, but you're able to attract capital, then you can buy a real business with the capital. Especially if it's cheap money that people are just throwing at you, and your share price just continues to go up and up. So I think that's what's happening. And ultimately, from the positive side, like obviously from the initial side, like, oh, it's kind of dangerous, and it is. But ultimately, the investors may not know that they're the ones footing the bill for that acceleration. But from a world point of view, say from me looking at it, it could be a good thing, as it would further accelerate the world standard of living, right? So money's going to people that have ideas. And what that means, either they'll lose their ideas to buy a company that can execute on the idea, or the real companies will be like, oh wow, this guy's getting a lot of money for thinking about it this way or tackling a problem this way, so we're going to do that too. But anyway, that's a lot of thoughts. A lot of dump on you. The video's always gotten longer than what I wanted. But anyway, happy new year. We'll be back at it tomorrow morning doing a normal company. And yeah, have a great rest of your day on this January 1st, 2021.